Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. This week on the podcast, I kicked off by talking to one of the key figures in the investment trust sector who's worth talking to at this particular time, given all that's going on in the world, and not least the emerging and evolving trade war between the USA and China. And that guest is Dale Nicholls, who is the manager of the Fidelity China Special Situations Trust, the oldest and the largest of the China trusts in the investment trust sector, where he's been the manager for 11 years, something like that. So, diving straight in, if I may, Dale, the outbreak of this trade war between the US and China is probably not what you were wishing for as you entered 2025. I remember back in the latter part of last year, you were making very positive noises about China and the equity market there did pick up. But that's all pretty much gone into reverse since President Trump took office. So perhaps I just asked you first what your reaction to this unwelcome development has been.
Yeah, I suspect I'm like a lot of people in the markets in terms of being surprised and really trying to understand the strategy and obviously thinking about the impact for my companies as well. Clearly, I think the impact can be significant globally in terms of just sort of general economic impact. But yeah, I mean, it's fair to say it's definitely escalated far more than we would have built in to our expectations. So we've got to see where that goes.
Have you got a feeling or perhaps some indications as to how the Chinese are likely to respond? It doesn't seem like they're in the mood to back down anytime soon. Perhaps the only large trading partner that's actually retaliated in kind so far. That presumably doesn't come as a surprise, though, for a whole number of reasons, including loss of face and also perhaps some calculation as to whether they can win this trade war or not.
Yeah, I don't think there's any surprise. I mean, they've been pretty consistent, I think, in their approach, both now and sort of over the years. So I don't think there's really too much surprise there in terms of the response. Like we said, it's definitely escalated. If we're talking about 145%, it's in some ways the good news is any sort of escalation from there really has no more impact. We're sort of at maximum impact and it won't have sort of real impact on the economy from here, which is one way of looking at it. So I think it's probably fair to say these are the peak levels, but we'll see where it goes.
I think I noticed some estimates that if they stay at 125%, which, as you say, we don't know whether that's going to happen or not, that's going to have perhaps a notable impact on Chinese GDP. But of course, the amount they export to the US is not a huge part of GDP, something like 2%. Is that the kind of impact it's like?
Yeah, there's a range of estimates out there, but I think general consensus would be at these levels, we're looking at sort of 1.5 to 2%. So not insignificant. I think the response from the Chinese side will be to see where things do settle and look at how they can respond domestically in terms of stimulus as a result and somewhat of an offset.
They obviously announced this significant stimulus package back in September last year, I think. But they've got room to do more, obviously, and is your instinct that they will do more if this persists?
I think definitely. Like I said, they're sort of looking to see where things settle and be looking to do more to offset. I think that's probably a fair assumption. So, they'll be, again, evaluating to get a better sense of where things actually settle.
Yeah, well, that must make it pretty difficult for you, though. You've got to try and manage your portfolio through this. I did notice, looking back over the last 9 months, I guess, or so, that a lot of the sectors that did very well when the market was stimulated went up. They're the ones that perhaps have retreated most since then. So how has that affected you? Have you had to do a lot of repositioning in the portfolio, or is it the question of sticking with where you were at?
Not really. The vast majority of the portfolio is focused on domestic opportunities. If we look at our total US exposure in terms of revenues, it's definitely single digit. And I think for MSCI China, it's around the 3% level. So, I'm still of the mindset that this is not really significant. It's not a big driver for the portfolio. But there are some names that we do have in the portfolio that have higher exposure. A lot of them did get really cheap over concerns around the sort of tariff risk. And when we're talking these types of levels for those companies, it's going to be disruptive. I mean, there's no question. There's definitely going to be a pretty significant air pocket, I would assume, in their business in terms of orders. So they're the ones that we've had to look at. What I think is interesting is when we evaluate the impact for a lot of these companies that do have the exposure, the discussion goes along the lines, none of them are that concerned about market share loss. It's not like there's a local US competitor sort of waiting in the wings. For a lot of these sectors, all the competition is Chinese. They have a similar supply chain. And so the discussion comes around, okay, if we're taking tariff levels to these levels, how much does pricing go up and what is the impact on volume? So it's a price elasticity type of discussion. And that's the sort of discussion we're having. But with the types of price hikes that we're talking about, it's hugely disruptive on both sides, of course, for the distributors, et cetera, on the US side. So, you've got to assume that we're going to go through a period where there's confusion and not a lot of decisions are going to get made. So I've had to mitigate the risk with some holdings that have that type of exposure. Obviously, continually evaluating that things do adjust pretty fast in terms of prices, in terms of stock prices. So keeping that in mind, but definitely have made some adjustments for companies that do have that type of exposure.
Can you just quickly give us a couple of examples of the kind of companies that you have
Yeah.
made the adjustments to?
Maybe I won't go into individual names, but if I think about things like power equipment, the types of companies that are in that space, as I said, oftentimes very similar sorts of supply chains, and the vast majority of it's coming out of China or out of Chinese players in other markets. But that would be one example.
Okay, so one of the concerns over in Europe, for example, is that a lot of Chinese things have been exported to the US will find their way into our markets instead. If that's the case, then obviously depending on the price they charge, but that would mitigate some of the damage, I guess, in other markets. Is that likely, do you think?
I think in my discussions with the companies that we're talking about, definitely naturally they're looking at other markets, and Europe would be one of those. So I think that's a sort of a fair base case assumption that they're going to be looking at developing other markets where they can. But, for many of them, the US is a big market, so it's not going to fully offset.
So one of the notable features of the way you've managed the investment trust is you do run it with quite a high level of gearing. What have you done about that? I mean, that was running, I think, 20% or 25% even at one point, net gearing using CFDs. What have you done about that? I mean, that was quite a strong statement about where you thought the markets were going. Would that be a fair interpretation?
Yeah, in aggregate, things haven't changed too much. We're still got gearing around that 120 level, so relatively high. And again, that reflects the types of opportunities that we're talking about. As I've said, there is going to be, I think, a renewed focus on the domestic economy. Obviously, that was the big kind of pivot that we saw from September last year. I think that is definitely going to continue. There's obviously a recognition that at the sort of trade side of the equation, and I think there's going to be an even greater focus on the domestic side. So I think that's throwing up opportunities. You talked about some of the sectors that have been impacted post Liberation Day, and areas like consumer discretionaries have been significantly hit. And we see many examples of companies that have virtually no impact at all from the trade war, and they've been sold off in sympathy. So there's definitely real opportunity there. Again, with the prospect down the road of increased stimulus. So we're still quite positive on the consumer, as we've talked about in the past. That the consumer in China is definitely cashed up. We've seen savings rates go up through COVID and post COVID. There is a confidence issue, but hopefully that can be gradually addressed. We haven't touched on property, but I think that has clearly been a factor that has hurt consumer confidence. But, we're seeing increasing signs of stabilization in that market. If you look at sort of the pricing trends in first tier cities over the past few months, they've clearly stabilized, if not increased, on a sort of month on month basis. So I think there's increasing signs that things are stabilizing in the property sector. So looking forward, I think there's pretty good prospects that that won't be the drag that it has been over the past few years. And again, if the consumer psyche can adjust into thinking that is definitely a more stable part of their balance sheet, again, I think there's reasonable prospects for a gradual recovery on the consumption side.
I don't know how often you actually go to China these days, but to what extent are you able to describe the kind of mood there? I mean, judging by the media or by just talking to people, I suppose Chinese industry is the most important one, but how do you think the Chinese consumer is reacting to this news about the war against the US in particular?
Yeah, I think like a lot of us, they're trying to process things, trying to understand where things will land. I think we're still really in that phase. I think there were signs of early sort of green shoots on the consumption side, but I think in general, it's really wait, see, evaluate. That's the kind of mindset.
I don't know to what extent you have a view about the currency, but obviously that's one of the things that's going to be quite important going forward. We know that the dollar has been weakening significantly as a result of all this. And I guess that poses a bit of a challenge to the Chinese for how to deal with that. Do you have any particular insights or expectations about how that will unfold? And what would it actually mean for the trust if that were to happen, if it was to move significantly one way or the other?
My base case would be, and the reaction that we've seen so far is actually it's been reasonably stable. Having said that, probably the direction of rates in China is still down. And we're definitely still in an easing bias, I think, in China. So I do think there's a likelihood of rates to fall further. So just thinking logically, that's probably something that's likely to contribute sort of a weakening currency. But the sense we get is that there's not an overarching policy of really wanting to weaken the currency. I think, again, the general mindset is around stability being key. So I'd be surprised if there were big currency moves either way, to be honest.
Okay, well, that will be an interesting one to watch. And just talking about the market generally, I mean, one of the attractions, obviously, of people thinking about your trust or about the Chinese equity market in particular is that it is relatively cheap. Well, a lot of things are relatively cheap compared to the US market. How would you quantify that? And how does the metrics on your portfolio compare to the average for the Chinese market as a whole, depending on which index you use, of course, always an issue.
Yeah, it's definitely moving around, but the general sense is we're probably on 10 to 11 times forward earnings, maybe closer to 11. And just looking at the trust, I'd say we're slightly below that and growing faster. So we'll see where sort of estimates land. Clearly, for the companies that are impacted, that can have an impact on growth, but we're still looking at pretty decent growth prospects. So yeah, we're sort of landing at that level, which would be, I guess, sort of approaching a standard deviation off historical averages. And although the gap with the US has closed somewhat, it's still large in terms of that discount. So yeah, I do still think there's pretty high risk premium that people are applying to China. And I do wonder if there's still reasonable prospects for that gap to close. If you think the risk and variability of government policy is a factor that should be entering into that equation, we're seeing a fair bit of variability and change on the US side relative to the Chinese side, which is pretty consistent. So one thing we do debate internally is just the potential for that sort of risk premium that's applied to the China side, versus the US to potentially close over time.
I wanted also to ask you about the response of your shareholders or your unit holders. You run an open-ended fund as well. Have you seen outflows from the open-ended fund? And obviously the investment trust, the discount has hit your 10% discount control level recently. It's currently, I think, just under 10%, and you've been buying back some shares. So what has been the trend, if you like, of shareholders' behaviour since the stimulus, say, since last September?
Yeah, on the open-ended side, I think as a house, things have been pretty steady for us. I can't speak for everyone, of course, but at least for the funds that I run, it's been pretty stable. For the trust, as you've said, clearly the discount has expanded, but it's definitely has been wider in the past. And these are the times when the board is definitely in the market implementing their policy of keeping that in single digits. So I think it's fair to assume that at these levels, there'll be pretty consistent buyers in the market.
I was just wondering whether the improved performance of the market last year had actually led to some significant increase in demand and whether that's just been cut off just as it was building. That seemed to be the impression I was getting.
Yeah, it was a pretty clear turning point around Liberation Day, and that was following what had been a pretty positive start to the year. So it is disappointing, but this is the market we're dealing with. You go through these phases. As you know, China is a market where sentiment can shift pretty significantly. And as we've talked about, not all of it is what we see in terms of the fundamentals for the companies. As I've said, a lot of the companies that we look at have no impact at all from what's happening with tariffs. So again, this is sort of an opportunity to add to those names, and there's quite some opportunity I see, particularly in the consumption space.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. Can I ask you about your unlisted holdings? You have, I think, about 9% for unlisted holdings, and you make some comments about that in your last report, your interim report. Do you think that's been, on balance, a negative? It's been a negative for a number of other trusts, or appears to have been, like the Bailey Gifford ones and so on. I don't know how long now you've been running that sort of size of unlisted position, but do you think that has actually had a negative impact on sentiment towards the trust?
It's hard to say. I'd be surprised if it did. I think a lot of us have followed our progress in the unlisted space over time. It's definitely been something that's added value and added to performance over time. I think I've shared my view on some of the larger holdings, the likes of ByteDance, et cetera, which we think we've added to at really attractive valuations. So again, I'd be surprised if that was a factor that was really playing into the discount. I think with most investors, they would view that as a positive, and they understand the positive contribution that the private side has added over the years.
So there's no current plan to change that in it, particularly the kind of proportion you have. Is there a target to go up or down from here, or is it maintained around the same level? Obviously, depend on the valuations that you apply to them, of
Well,
course. But yeah,
yeah. I mean, this will really depend on the opportunities. We continue to look at opportunities in the private space. There's no question the valuations have come down. There's definitely less competition for deals. So, it's always hard to predict, but I do think there will be more deals. But at the same time, they're competing with a public market that's also pretty attractive in terms of risk reward. So, yeah, I mean, I think there definitely will be opportunities. But again, I'd be surprised if there was a significant move up in the short term.
can I ask you about one theme which has obviously been very dominant in the market, and that, of course, is AI. There was a lot of excitement around the announcement by DeepSeek about what it might be able to do in terms of challenging the current team to be market leaders. Is that an investment opportunity for you, or what do you understand about that particular development? And do you actually see AI as a particular good, profitable opportunity, given that the Chinese do seem to have been working very fast in developing their own capabilities in that area?
Yeah, I think it's going to be a big driver of change and efficiency for a lot of companies. So it's definitely something we talk about in terms of how it's being implemented for many companies. As you've said, there are quite a few companies in China that, achieving performance numbers that are pretty impressive, even on a global basis. And again, sort of looking at the valuations that some companies have achieved globally, it wouldn't appear that the Chinese companies that are leading in that space are getting the same sort of impact in terms of how they're being valued if you were to look at them on a sum of the parts basis in China. So I think the biggest thing is how companies are going to be able to implement that. That's the thing that we're most focused on. And, we see some positive signs. Again, it varies by company, but we definitely see companies that are, we think, leveraging AI tools to improve their businesses.
Can you quantify the extent of the AI theme in your portfolio? Is it actually a theme that you identify separate from other themes that you have running there?
There are definitely names that are benefiting from broader themes about the use of data, of which AI is part of that. So if you're thinking about companies that have exposure in data centers and things like that, and obviously we do have holdings in the big tech companies that have their own models, of which ByteDance I would include as a leader in that space as well. So there's definitely companies that have exposure there. I don't know if I can really sort of lock down a total exposure number to that, but it's a pretty constant theme that we're discussing when we're talking to companies on the ground in the tech space.
Yeah, I'm just thinking really in terms of, say, can people looking at the trust or looking at the Chinese market, quite apart from the valuations, which look attractive on average, where the potential for particularly significant growth in earnings and valuations might come from?
Right. That really goes across a range of sectors. We talked about the consumer area. There's still, a lot of growth opportunity in the general consumption space. The general pace of innovation continues to be quite strong in China. As we've talked about in the past, you've seen private companies that have sort of compounded their R&D spend at 20% or so for the last decade. And you're seeing the benefits of that. And that's what's led to the types of leadership positions the companies have achieved in areas like the whole electric vehicle space, even higher market shares that you see in the supply chain leading into that. And there's still really strong stories around rising penetration across these sectors and market share gains. So if you're talking about growth in general, there's definitely a lot of opportunities, I've said, on the back of rising penetration and market share gains on the back of consolidation across a range of sectors as well. It's a lot of sectors that are quite fragmented and offer good consolidation opportunities. So it's pretty broad based in terms of the factors that are driving the growth that we see coming through in earnings in the portfolio.
What is the sort of biggest risks that you see out there at the moment that might, for example, propel you to reduce your level of gearing, for example? What are the bigger risks, apart from, I suppose, the obvious one of, I guess there'd be some fear of military developments or geopolitical developments? Or is it just simply the fact that this tariff war goes on for longer than perhaps people would like or expect?
As I talked about earlier, that's clearly going to have an impact on growth. So, to the degree that impacts global growth, that's a risk factor. If we were to go to a stage where the trade war went beyond to something that's more financial, that could definitely have implications as well in terms of impacting just general financial actors. That would definitely be a negative factor. I'd say unlikely, but if you had to really step back and think about risk factors, if things were to escalate into that area, I think that could definitely be a risk factor.
I'm not quite clear what you mean by that when you talk about financial factors. What exactly are you talking about there?
I'm thinking about access to things like SWIFT, general sanctioning of banks, and the sort of listing of Chinese companies in the US. That's the sort of thing.
So if we're looking forward from here, obviously there's this short-term cloud, which could become a medium-term cloud, I guess, hanging over the whole situation at the moment, which will take some time to resolve. How would you make the case for China as a part of investors' portfolios? The returns over the last 5 years have been pretty modest, I think it's fair to say. But then you did have a very exceptional year in 2021, didn't you? I think that was pretty remarkable. And I think over 10 years, it's about 5% per annum annualized return, which is not particularly great. How would you make that case today, given what we know?
As we've talked about, the sentiment towards China can shift pretty significantly over time. We're clearly in, I think, that fear phase now, and that's getting reflected in valuation. So there's a lot of value out there. I think the biggest concerns are these geopolitical factors, and yet a huge proportion of the types of companies that we're looking at are not impacted by the trade war. And in fact, sitting there standing to benefit from increased domestic stimulus. So I think, again, there's a lot of opportunity in those types of names. What's really going to drive the NAV over time is that growth in earnings. And that's sort of what we're out there looking at, and what the team is looking at each day is trying to get those earnings right. And we see a lot of value out there relative to the types of earnings growth that we're looking at. So now is the time to be more greedy in terms of benefiting from those opportunities. And that's what's coming through in the gearing for the portfolio. I think that's the main story. A lot of the factors that have sort of dragged the economy and the market, particularly areas like property, I think are becoming less of a drag. As I said, good signs of stabilization. So from here, if you're focused on that domestic opportunity, I think there is quite a bit of an opportunity there.
I was just thinking, looking back to when the trust was launched, obviously it was quite a big thing at the time. And the story was a lot about the emerging consumer class in China and obviously the continued high growth rates we were seeing out there and the emergence of new companies in new areas and so on. The story today is a little bit different in a way because of some of the things that already happened, if you like. And the consumer, as you say, has slowed down. There have been these concerns about property, which has had an impact. And now we've got these global geopolitical issues to deal with. But I guess what you're saying to me is that the Chinese economy continues to grow, not as fast as it was, and it's penetrated a long way in a lot of markets like automotives and so on, and they really have taken over the world effectively. So there's a different story, but it's still an exciting one. I mean, you're happy to be.
I would say, I think a lot of the things we talked about are consistent. There's still the penetration story. The growth of the middle class for the consumer is definitely a key part of the story. And that pace around innovation is played out and is playing out. We've had the creation of whole new industries. And, a lot of the companies are reaping the rewards from really increasing their competitiveness, investing in increasing their competitiveness over time. It's fair to say that some markets will be harder to access going forward, but at the same time, there's a lot of, really innovative, competitive companies that are coming through, and the growth prospects for them are stronger. And a lot of those opportunities are happening in the domestic market as well. So it's not all about going global for a lot of the companies.
Well, there was this moment, wasn't there? Well, I can't remember exactly how long ago it was now, but when the Chinese authorities effectively closed down a couple of sectors like education and so on in terms of stock market listed companies. But I don't think we've seen much more evidence of that more recently. Is that still a risk that investors should be mindful of?
I think that's much less of a risk in terms of domestic regulation. We track the shifts and try to track the sort of general trends around regulation. And to what we see is the focus is squarely on growth. That is really what the regulators are focused on right now. And it's interesting because we get comments about those sectors that were impacted by that. And most of the companies that were impacted are seeing new highs in earnings. So I think the general trend is much more on promoting growth as opposed to restricting it.
Okay, on that note, I think that brings us to the end. Really interesting conversation. I think will be of interest to lots of investors at the moment. So I'd like to thank you, Dale, for taking the time to talk to us about what is undoubtedly a very interesting and evolving situation. So that was Dale Nicholls, the manager of the Fidelity China Special Situations Trust. Market cap about $1.5 billion, by far the largest trust in its sector.
Thanks, Jonathan. Appreciate your time.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.